Welcome back to Quant Forge. On this channel, we test trading strategies with real data, real Python code, and real backtests. No magic indicators, no secret institutional edge, and no thumbnails featuring a man screaming next to a rented Ferrari. Today, we are testing a strategy that sounds emotionally compelling, which is usually a bad sign. The idea is simple: only buy Bitcoin during market crashes. That's it. No trend following, no machine learning, no AI generated volatility regime filter discovered during a caffeine overdose, just pure panic buying. First, we download Bitcoin data going back to 2018. Then we calculate daily returns. Nothing complicated yet. At this stage, every strategy still feels employable. Next, we define a crash. In this test, a crash means Bitcoin falls more than 5% in a single day, which in crypto is considered a mild emotional inconvenience. Whenever that happens, the strategy buys Bitcoin and then holds for 5 days. Very simple. The logic sounds reasonable. Markets panic. Mean reversion happens. Fear creates opportunity. Financial Twitter posts motivational quotes. Everybody heals. Now let's test it. First, the equity curve, and immediately, this does not look encouraging. Buy and hold Bitcoin is the cyan line. Violent, chaotic. Okay? It's occasionally life changing. The crash strategy is the yellow line, which appears to be slowly descending into financial hospice care. That is not ideal. The strategy triggered 165 crash signals, which sounds diversified. Unfortunately, it mostly diversified the losses. Now, the performance metrics. Buy and hold returned roughly 463%. The crash strategy returned negative 79%, which is not technically impossible, but it is ambitious. The Sharpe ratio was negative 0.25, meaning the strategy delivered volatility without the traditional inconvenience of profits. Now, here's the fascinating part. Conceptually, the strategy sounds intelligent. Buying panic, it feels rational. It feels contrarian. It feels sophisticated. But in practice, Bitcoin crashes often happen during much larger structural downtrends. So instead of buying temporary fear, the strategy repeatedly buys into ongoing collapse, professionally timed emotional damage. Now, let's look at the drawdown chart, and this is extraordinary. At one point, the strategy is down more than 80% from its peak, which means the system successfully transformed Bitcoin into something even more psychologically harmful than Bitcoin. That takes effort. Now, obviously, this is not a complete production strategy. There are no transaction costs, no slippage, no position sizing, no exit optimization, and no risk management created after reading 3 hedge fund books and developing a superiority complex. But honestly, none of those things were saving this. The core idea itself simply failed. So, and that's important because a lot of trading concepts sound brilliant in isolation. Buy fear, fade panic, be greedy when others are fearful, very inspirational, very Warren Buffett. But markets are not motivational posters. Sometimes panic exists for a reason. And in this case, the strategy mostly functioned as a highly efficient system for purchasing weakness immediately before additional weakness. Anyway, this is Quant Forge. We test trading strategies with real code, real data, and objective backtests. No fake gurus, no magic systems, just ideas,